Hey, all you beautiful people. Micah Roquiero, Mr. Utah Real Estate, coming at you with another podcast. Today, we're going to talk about seller finance, and I brought with me today an expert in seller finance. He's been doing this for close to 20 years now, investing and into real estate. This is Christion Sadler. He's also with Top Equity Realty, one of our agents here. Christion, if you wouldn't mind, actually, before we get into Christion, don't forget, subscribe. Hit the like button, hit that thumbs up. Give us a comment, let me know what you guys think, if there's anything else you want us to cover, any questions you might have for either one of us, it'd be great, thank you. But again, Christion, I'd like to know a little bit about your background, how long you've been doing this, and what you've been doing as far as real estate and seller financing and all that.
Yeah, so I got into real estate as an investor when I was 22 years old, so 40 now, and I guess it was 21 years old, and then I quit my job when I was 22 years old, went full-time as an entrepreneur real estate investor. So I've been doing it a while. I've definitely seen some ups and downs. I quit my job way too early in the beginning and saw some really rough times, and then some really sharp highs, and on the excitement of the 2006 era, and then some quick downturns come mid-2007. So during that time, me and my partner had acquired about $3 million in real estate, and about $1 million of that was equity. But quickly I found out equity doesn't mean much when the market shifts. And so that value, while we were in the process of literally switching that to where we would have been able to leverage out the equity and buy a multifamily property in Texas that would have literally paid all of our bills, we missed the mark by a matter of just weeks, probably, because the banks started shifting very quickly, and those loans that we were pre-approved for quickly just went away. And nobody knew what was going on at the time, so lenders kept saying, we can get it done. And ultimately went through a really rough time, but that pushed me back into going to the basics of subject to seller financing, short sales. We did a lot of different things, and many of them were creative strategies. And so there's times where we would kind of do a hybrid back in the day, where you could get the second to discount on a short sale situation and then take over the first, so you get rid of those large second lien positions, and now all of a sudden you've got some built-in equity, and you can hold on to that property without having to go pay hard money fees or get a new loan. So lots of creative things that we did along the way. And that got me to the point where we were doing all kinds of different strategies, a lot of flips. Call myself a recovering flipper, because even the properties that we planned on keeping, it seemed like we kept selling them, within a matter of a short period of time, because sometimes that was the only way to access the equity. We're actually seeing that again right now in the current market environment, where I'm selling one of my commercial properties that originally when we bought it we thought we'd never sell. And cool story with that. I won't get into all the details, but we're selling it to the tenants. They had a first right of refusal that they're executing on. So we've done commercial, we've done land, we've done residential, multifamily, kind of just about every type of real estate as an investor I've been a part of in some way, some form or fashion. And then just recently got my real estate license about 3 years ago now, just over 3 years ago. I saw a need in the market for agents that were going to do more than just the standard. In this market, you really have to add additional value as an agent. I mean, you don't have to. There's plenty that don't, right? But when you do, you can set yourself apart very simply and easily. And I've been grateful to have a pretty great little business here from the traditional real estate side, and that's without a whole lot of my time or effort, because I've also, over the last 2 years, been building a startup in the real estate syndication space. And that has taken a tremendous amount of my focus, and we're doing some things that are going to change the world of real estate syndication, potentially forever. And so exciting things going on there. So that's kind of my story in a nutshell.
So a lot of experience. You've pretty much seen it all from your almost 20 years of experience now. Hit the highs, the lows, seen it all. But today we want to focus more on seller financing. That seems to be a big thing these days, is seller financing. What is seller financing? So I wanted to tackle that with you, kind of give our viewers an idea of what seller financing is, how you can use it as a residential, as a buyer for a single family home, or as an investor as well. So let's tackle that. So seller financing from a residential side of it. How does seller financing work? What is it exactly, and what is the benefits of seller financing for a buyer or a seller?
Yeah, so it's pretty simple. It just means that the seller is not going to require you to go get the money from the bank. They're going to allow you with whatever down payment. Sometimes it's small, sometimes it's large, depending on the scenario. If it's more of a need to sell situation, then they're not so concerned with the down payment as much as, can you take this problem off my hands? And that was me for a long time, was taking the problem properties off of people's hands. But then on the other side, it may just be that they want to offer more creative solutions, they want to try to get more money, or they want to sell it in a market that is a little bit challenged as far as banking is concerned. And so it really comes down to the seller does become the bank in this scenario. So you pay your down payment to them, and then they're going to allow you to make payments over time. And typical situation, it'll be just like a typical mortgage loan. So it's going to be amortized over a 30-year time frame. You might have a balloon payment, which is a little bit different than a traditional bank, because a lot of sellers, they don't necessarily want to have that house in their name long term. They ultimately want to get paid off. But not all of them require that either, right? Sometimes, again, if it's you solving a problem for them, then they don't care as much. And then there's some different variations within it, because seller financing, in the general sense, kind of is all encompassing, whether that's a subject to transaction, whether that's just a straightforward seller financing because they own it free and clear, or a hybrid of some sort. There's lots of different ways of structuring it then.
So you mentioned subject to. So what exactly is subject to?
Yeah, subject to, it means subject to the existing financing staying in place. Funny story for you on that one, by the way. Early in my real estate investing journey, when I was really young, early 20s, right, and I was learning about real estate, I was going to these events with all these different real estate investors, and I kept hearing this, subject to. And at that point, I hadn't really integrated myself in. I wasn't very good at like the social situations and, meeting people. So I was just kind of showing up and then paying attention. But I kept hearing about this subject to, and on my mind, I'm like, what is subject one? And it took me about 3 months before somebody actually took the time to give that explanation that I just did, taking it over, subject to the existing financing staying in place, that I was like, oh my gosh, I'm so dumb.
So explain that. So I currently have a listing up for sale, and I've approached my seller about possibly doing a seller financing as well. Now there's the two, there's seller financing and then seller financing subject to. So for like a residential home, say let's use an example. He wants to sell it for $700,000. He's got $200 in equity in that home and wants to try and get as much of that equity out as possible because he needs it to put down on a new home. So subject to versus just regular seller financing, what would be the differences in that scenario?
Really, so the difference is if they still owe money to the bank, because typically somebody can't do seller financing and pay off their bank, right? Like you said, typically they have a certain amount of equity and they're trying to get as much of that as they can, and then they're going to let their loan stay in place. And so the ownership and the title is usually going to switch hands in that scenario. So if I was buying this listing from your seller, for example, the property would go into my name. They would get the down payment, but the loan would stay in their name. And legally, they can't transfer that liability, right? So they, unless it is assumable, which is another thing that we could talk about if you want to, but that's not seller financing. But anyways, you're not assuming the loan in a traditional sense. They're just giving an all-inclusive trust deed. Typically, is going to be the document that you file, which means there's going to be the first lien is going to be their lender, and then there's going to be a second lien that is all-encompassing of the first lien position and whatever equity they may have in the property. And even if that equity is zero, you still have to do that all-encompassing, because I'm not paying to the bank, I'm paying to that individual. And usually we're going to put some sort of an escrow service in place to make sure that their bank is being paid. Because the last thing you want to do is start paying payments to somebody and they have a bank loan and they're not making their own payments. And now all of a sudden you're losing the house even though you've been making your payments, right? So there's a lot of nuances that you want to make sure that you understand. And then it comes down to there's different levels of seller financing as well, where you could do a lease option, which is kind of it's not technically seller financing, but it's very much like seller financing in that you're getting the option to buy it at a certain price later on, right? Or there could be you could do seller financing utilizing a trust. And so sometimes you can put a trust in place rather than an all-inclusive trust deed. There's many different ways of structuring it. You could also do a contract for deed. Contract for deed is a little different because the title does not transfer until the contract is complete. Meaning, we're going to have a contract. The title is going to stay in your seller's name, so it doesn't come into my name until I go to refinance or pay them off. Now, some banks will allow that. They can look at that documentation, and they can allow me to come in and do what would be like a refinance. But it's not a refinance because I don't own the property yet, right? But they'll kind of underwrite it as if it's a refinance. Whereas if I take it over subject to or just seller financing, I already own the property. So at that point, whatever amount of time has passed, I can show ownership during that time. And oftentimes a refinance is a lot easier to qualify for than a purchase. And I guess I should clarify, it's not always easier to qualify for, but many times you're not required to have as much as far as a down payment. They don't source the funds the same way. So sometimes, this is a way somebody can get into a property and then, use the equity that is in that property as their down payment, so to speak, and then refinance later on.
Okay. So I was going to ask you about the escrow part of it. So we bring in an escrow service to kind of take the lead on making payments and making sure the banks get paid. So not necessarily you're paying to the seller, but to an escrow, and they're taking care of payments for you and kind of keeping everything in check for you.
Yeah.
Is that correct?
Yeah, typically you will. Now, I've done it before where I just pay the mortgage company directly. And that especially comes into like subject to, for example. So there's been cases in subject to where there is no equity there. So essentially in the contract, I'm giving them whatever amount of money that I'm giving them. I've even had people pay me to take over their properties, right? Because they just don't want the burden of it. They don't want the potential of a foreclosure on their credit, which could stop them from being able to get into a home for a long period of time. And then in that scenario, you can just pay, the bank directly. But it's all about protections, right? And typically, if you're coming from an agent standpoint and you're facilitating a buyer or a seller, you want to make sure that all parties are protected. And the best way to do that is to just have a third-party escrow service of some sort.
So, but seller financing also, it's a larger down payment than a traditional loan, most of the time, right? Now, why would a buyer want to go that route? Why would a buyer want to put a big, huge amount down instead of a 3% or a 5% on a conventional loan or something like that? Why would they want to put up to a couple hundred thousand, even maybe possible? Why would a buyer even want to go that route?
Yeah, there's lots of different scenarios. So oftentimes it's because they don't fit the typical banking guidelines, right? So they might be a business owner, and maybe they moved their business from California to Utah or something like that. And this is actually a scenario where I sold one of my own properties, one of my personal properties, on seller financing to a gentleman because he had started a landscape company. He's doing phenomenally well as far as income is concerned, but he hadn't been established for 2 years in Utah. And I mean, his whole life had been in landscaping, right? But he hadn't been established for 2 years in Utah, so the banks didn't want to give him a loan until 7 months later. And so essentially we just did a shorter term seller financing. We gave him the 7 months. He ended up taking an extra month, and we were fine with that, right? We were a little bit more flexible because it would have taken way longer to, well, this is the reason why I shouldn't say because, but just for anybody that's listening to it, it would have taken longer for us to try to go through the foreclosure process and everything else, and it would have caused all kinds of, contention within there. Whereas it was like, hey, he was making the payments, everything was, fine, and he took that time, he got it refinanced. Other situations might be that they have a TIN number rather than a social security, and so sometimes those are harder to get loans on. There's all kinds of different scenarios where somebody needs to buy, they don't fit the typical banking guidelines. And maybe it's that they want to buy a house and the money for the down payment they're borrowing from somebody else. So something to think about if you're looking to buy a house, you go to a family member, right? and say, hey, cousin Joe, I know you've got some money sitting in a retirement account, or sitting in a money market account, or you just got that big bonus from your job. What if you lent that money to me, secured against real estate? I'm going to buy this property, subject to the existing financing staying in place, or with seller financing, and that's their down payment. A bank, typically, they'll only allow a certain amount of those funds to be gifted funds, right? And they also need to source it in specific ways. Whereas like with a seller financing, I could go borrow the money from somebody, I could pay them 12% interest, and have them as a junior lien holder on the back end of that property, so that they have some protection built in as well. Now, first lien still has the most protection, and then the all-inclusive trust deed is going to be essentially the second lien, so they have extra protection, and then you have that last lien holder. There's other scenarios where maybe somebody's buying a house together, and so who do they determine gets to be on the loan, and they don't want to have to split equity based on who's qualifying and who has money. And I mean, there's just so many different scenarios, and we haven't even talked about investing yet, right? Because it's a great strategy when it comes to investing, because typically a bank is going to allow you to have about 10 mortgages in your own name. No matter how well you qualify for them, there's kind of a cap where the banks say, we don't want you to have any more mortgages in your own name. Whereas with seller financing or subject to, you're unlimited, right? Because you don't have those traditional mortgages. You don't have to go through the typical bank underwriting. So you could literally buy as many houses as you want utilizing that strategy.
Great. So that's some of the reasons why a buyer would do it. Now, what would be some reasons a seller would actually get into seller financing? Are there any pros, cons to the seller side of this? How could it hurt the seller? How could it help the seller?
Yeah, so from a seller standpoint, there could be numerous reasons. A lot of the reasons are that they can't sell it traditionally. Because obviously, if all is the same and I can get a seller financed offer or I can get a cash offer, usually I'm going to take the cash offer. Now, sometimes I will say that the reason that they take this seller financed offer is because they have some specific tax strategies, right? And you'll have to talk with your accountant on this, but essentially you can take those gains over time by selling it in a way where you're not taking them all up front. Again, I'm not the guy to give you all the details on how that can work, but for some sellers, that's a way that they strategize on taxes. For others, it's just simply, this is the way that I can get my house sold. So for example, if they're in a market where they're not getting as much activity because interest rates are high, right? And right now they're high, comparatively speaking to where they were a few years ago. So the market is still adjusting to those interest rates. And sometimes it's in a scenario, and I'm seeing this right now, where they might have bought their house a few years ago when interest rates were low, and then they're wanting to pass on, some of that savings to that new buyer to attract, a more qualified buyer, so to speak, or to compete against the new construction out there. So unfortunately, if you bought a house and you're just a traditional seller and you're in an area where there's a lot of new construction, there's been a lot of incentives offered to new construction that are not offered on a traditional
builder
home.
incentives.
Exactly. Builder incentives, and then there's also the state incentives that you just came out.
And often, sometimes there's the lender incentives as well.
Yeah, exactly. And so it's a way to compete, I guess, is the long and short of it. Is it's going to be a way to compete, or a way to strategize on how you take that money.
So talking about rates, so let's use an example again. The $700,000 home, they've got a 3% rate on it right now. They go into seller financing. That's 3%. If I'm saying this correctly, you can charge whoever's buying it an additional rate, right? So say they're paying the 3%, you charge the buyer 4%, which is still a great rate for the buyer. Now that 1% can come in as kind of a cash flow as well. Is
absolutely, correct? Yeah. So the difference between what you owe and what it's worth is typically anything being paid on that is going to be cash flow. And then if you can mark up the interest rate in any way, that's going to be additional cash flow as well. So this is one of the strategies that has come around a lot recently as well. As somebody says, I want to move, but this new interest rate, I'm going to get half the house for double the payment, right? That's kind of the feeling that they're getting. And so there's a way where they could essentially sell this property that's at, let's say, 3% interest, like you're saying, offer 6%, and then come over here and buy this new property at 6.5%, and now the extra cash flow on that money over here, that extra 3% in payment, can be offsetting what they're paying on their new property. So essentially, it's like bringing your rate with you, so to speak, right?
And so it sounds like a lot of benefits for the seller doing a seller finance. Or is there any downfalls to a seller finance? What if the buyer decides a year down the road, I lost my job, I'm going through divorce, whatever, I don't even care anymore, I'm not paying anymore, I'm done. Mm-hmm. What happens to the seller?
So same risk as a bank would have, right? And so in that scenario, if that person stops paying, then you have to go through the foreclosure process. So I think it's 210 days minimum in Utah, as far as with our rules, to go through that entire process. If you file everything correctly on the correct dates and everything else, you're looking at a minimum of about 210 days. So you want to build in, make sure you get enough of a down payment that it's not easy for somebody to just walk away, right? And then you also want to make sure you set some money aside, because if you've got to go through that process, you are still liable for the bank loan, right? And so if that person stops paying, the bank doesn't give you a pass. So essentially what you want to do is you want to make sure that you can still pay your payment to the mortgage if those other people stop paying, and pay the fees, or probably a few $1,000s in fees, to be able to go through the foreclosure process. But the benefit is to that, so there's pros and cons, right? The benefit to that is if they've put a large down payment down. So for example, if this was a $700,000 house like you had mentioned, and these people put $200,000 down, that $200,000 is already yours. Yeah. And so now you're taking back the house at $500,000 owed to your mortgage, maybe even less, and you can go right back. You can turn right back around and sell it again, or you could hold on to it at that point. There's lots of scenarios. And then the other potential risk, and this is a risk for both sides, by the way, is what's called the due on sale clause. Now, the due on sale clause, I feel like, is dramatized a little bit more. Every mortgage has it built in. It's just, I shouldn't say every, right? Because we don't want to talk in all encompassing. But most mortgages are going to have a due on sale clause. But that due on sale clause could have all kinds of different things in there that could spark it. In fact, there's some mortgages that even not maintaining the yard could spark the due on sale. It's really there to protect the asset of the bank. And the bank, their asset is not the home, it's the debt against the home.
And the due on sale, for those that don't know, is that when you sell the house, the bank requires you pay off that mortgage first thing. Right? So if it's changing, it's going from one person to another, it could trigger the due on sale date.
Yeah, so the due on sale clause is kind of what I was getting to, is what that means is if you're not meeting your end of the bargain on the note, then they can call the note due, which means that it needs to be paid in full immediately, right? Now there's a period of time within there, and quite frankly, I've seen very, very few due on sale scenarios. Now there's certain mortgages and certain types of mortgages that are more likely to call a note due. So Utah housing is one of those, for example. I would never personally try to do a subject to on a Utah housing loan. Very small department, they watch things very closely, they're local, right? Whereas the big national banks, they're usually not watching things as closely or trying to create issues. What they care about is, are they getting their payments? Like typically the bank cares about, are they getting their payments? And I actually have a story about this where a mentor of mine, and he's done a bunch of these, he had one where they called the note due and he sent in the payment and they took it. And then the next month they sent him a letter called the note due and he sent in a payment and they took it. And the next month they sent him a letter called the note due, he sent him a payment, they took it. And then they just stopped sending those messages.
All the bank wants is the money, right?
Typically, the bank just wants the money.
Yeah.
In other scenarios I've seen where, I've actually seen a friend of mine where he stepped in and refinanced the home. So he worked with his mortgage lender. He was able to refinance. He had sold the property on seller financing. He turned around and he was able to refinance the home and then let the buyers continue on with their seller financing. And I don't know how all the details of that worked. I know that it was a little bit of a stressful time during that scenario, but they got it worked out. And sometimes when you're buying these, you have so much equity in there already that it's real simple to either refinance or in some cases you just pay it off. You know, it might force you to sell the house, take your earnings, and move on to the next one.
So there's some risk, but not a lot, just because when you're doing seller financing, a lot of times the seller's going to want a big down payment. And that big down payment's going to save the buyer from defaulting on it. He doesn't want to lose all that money unless he's gone super crazy or something. But yeah, so it sounds like there's a little bit of risk, but not a whole lot for the seller side.
Yeah, I mean, real estate there's always a risk, no matter what you do, right? But it's just about weighing those risks and understanding them, and then being able to prepare for them. If you prepare as if the worst scenario is going to happen, it's more likely the best scenario is going to happen, and then you're going to have the upside. I shouldn't say the best scenario, but it's more likely much better than the worst case scenario is going to happen, right?
So another question. So a seller has his house up for sale, seller finance. He's offered seller financing to that, but he also needs to buy another property with the money he's getting from his seller. So we negotiated enough where he's getting enough down payment to pay down payment plus any other cost that may be associated, commissions to the real estate agents or whatever. So he gets all that. Now, is the lender for his new home, are they going to be able to still lend on this buyer who is the seller to buy a new home? Is this home still in his name, still connected to him? Is that going to have any effect on him with a loan for a new place?
It will have an effect, absolutely. And so that's the what you have to weigh out when you're doing this. You also want to make sure you have good lender relationships and you talk to them first. And so sometimes what the lender will say is, in order for this to work out, do a lease option up front that converts to seller financing later on, or just do a straight out lease option. Because in a lease option, you can usually count the rent amount, 70% of that roughly, as income, so you can offset that payment. Or certain lenders will allow you to, and it used to be where lenders would allow you to take the full amount immediately of that new payment that you were getting, because that was now an asset, right? So that note becomes an asset that's just paying you a monthly income. Now they usually need a certain amount of verification. So whether that's 6 months or a year of seeing those payments documented before they can offset the loan that's in your name. So again, talk with your lenders up front. If you're thinking about selling and you need that money to go buy, then you want to be educated on how am I going to go buy next. And sometimes if you're in a scenario where this might be the only way to get your house sold, then you can do it, and then you go find the creative way for you to buy it on the back end. So you get that big down payment you were looking for, and then you go put that down on the next house that you're getting into.
Sounds good. I think we've gone over quite a bit here on the seller financing. Is there anything that we've missed that maybe you need to add to that?
I think we've covered a lot of it. Again, when you're thinking about this, I talk a lot from the investor standpoint because that's like the first hat I put on typically, right? And so oftentimes if you're going to somebody to offer them seller financing, an easy way to talk about it with them is to say, listen, this is the asset you've already been trusting, to give you, returns or gain over the last however many years you've owned it. Why not continue trusting it? That's how we were able to buy, there was 2 houses on one lot, so basically a duplex. And when we got into negotiating on price, the wife gave me one price, the husband was thinking a higher price. And so I just used that as leverage and said, I'll tell you what, I can give you the higher price, but let's do it with seller financing. I'll give you a certain amount of money down that you need right now. But your main issue for them, it was they don't want to manage this property anymore. They don't want to be tied to it. They were getting to retirement age, so they want to go travel, and they don't want to have to worry about it. So I said, this property has literally been paying, it was a rental for them. This property's literally been paying you for over a decade, and you've trusted it to give you returns over that time. What if I just gave you a 6% return on your money, but you no longer have to deal with the ownership of it? I'll deal with the ownership of it. And it was a great scenario. It worked out for everybody.
So a lot of different scenarios where seller financing would be a great way to go about getting or selling real estate.
Absolutely.
So I think we covered a lot of that. If you guys have any questions about any of this stuff, leave it in the comments. Let me know what you guys think about that. Thank you again, Christion, for joining me in this little informative seller financing podcast. I hope it helps you guys. Again, if you have any questions, contact me. I'll leave Christion's information, his contact info in the description as well, so you can contact him. contact him as well. But thank you guys, and again, don't forget, subscribe to the channel, hit that thumbs up, leave us a comment. Appreciate y'all for joining me today. Thank you, and thank you, Christian.
Yep, thank you. See you guys.